So one thing that I like to do on my channel is to give valuations of companies. I like to see how they are performing relative to their stock price. But I think there's one misconception that I probably need to clear up. When I'm doing valuations of company, I like to usually see if the company is undervalued, overvalued, or trading at a fair price. So basically, is the company trading at a cheap or discounted price? Is it trading at a fair price where I'm paying fair value for the company I'm buying? Or is it trading at a premium value? I'm paying an expensive price for that particular company. Let me use this as an example. I recently did a video on Total Ghana where I gave my opinions on the company. I thought it was a good company, but I, as an investor, I tend to stay away from petroleum companies. It's a whole thing. I did a video, you can probably watch it. But when I did it, I realized that based on my estimates, the company was relatively expensive. It was trading at a high valuation. I think it was trading around a PE of 10 Ghana cedis. Yet to date, the company is up about 166%. It's trading at a stock price of 35 Ghana cedis. It started off the year at 13 Ghana cedis, 12 pesos, and it's now trading at 35 Ghana cedis as of September 12th. It all comes back to what actually drives the stock price of a company. And I think when you are glued to maybe your phone or your PC, seeing the price of a stock go up or down, sometimes you really forget that there's something behind the scenes that is actually causing that stock price to go up, and that is demand and supply. If, let's say, Total Ghana is actually worth 20 Ghana cedis, that is the actual fair price of the company, but there are people out there who want the company and are willing to pay 25 Ghana cedis for that company, and those people are a lot compared to the people selling that particular company share, that is Total. Definitely the price goes up. I don't think I'm the one to come and teach you guys demand and supply. I'm sure a lot of people have done economics and understand the basics of demand and supply. If there's a lot of people who demand something and there are relatively few people selling that particular thing, the price of that thing tends to go up. And the opposite is true as well. If there's a lot of people selling something and there's just few people willing to buy that thing, the price tends to go down. So if Total, again in our example, is worth 20 Ghana cedis, and a lot of people want to sell their Total, I, the Cedi investor, I'm just the only person who wants to buy Total. I can go to all the people and say, oh, I'll buy it at 15 Ghana cedis. And you have no other option because I am the only person willing to buy that particular thing. So you tend to reduce your price to meet my demand price, and a sale occurs. And I think this even brings me to my next point, and that is the greater food theory. I think this really expands on what I'm talking about. According to Google, the greater food theory suggests that you can make a profit by buying an overpriced asset, regardless of its intrinsic value, with the hope of selling it to another greater fool at an even higher price. This speculative strategy relies on an escalating chain of buyers, but it carries significant risks, as it can lead to holding a worthless asset if you are the last one to buy into the market. So that's why even if something is very overpriced, the price can still go up, and even if it is underpriced, it can still go down. It all depends on demand and supply. If there's someone willing in this greater food theory, an even greater fool who is willing to buy that particular thing at either expensive or cheaper price, the price will continue going up. And one thing that I really like about the explanation is this part, regardless of its intrinsic value. So the value of the thing, regardless of it being something very valuable or something that is worthless, as long as there's a greater fool who is willing to buy that particular thing, definitely the price will usually go up. So that's why sometimes there's a lot of speculative assets that don't really have any true value, like there's no intrinsic value or like underlying value behind that particular product or company or service. Their fundamentals are weak, whatever, but then there's someone willing to buy it at an expensive price. Usually the price would go up. So that's why it's always good to have an investment strategy, something you focus on you know that is what you are sticking to. And mine has always been the same: buy high quality companies, strong companies that are growing very, very fast and returning value back to shareholders, either through dividends, reinvestments back into the business, through heavy capex or whatever, or even growing their free cash flow, which can be used for other purposes. So at the end of the day, if I would want you to take something out of this video, I would say keep it at the back of your mind that just because a company is undervalued does not mean a stock price will go up. And just because a company is expensive or overvalued does not mean a stock price will come down. Comment down below what you think about this. Leave a like and please subscribe to the channel. Thank you so much and have a wonderful rest of your day. Peace.